Thank you. Oh, wow, that was an awesome first session. I now want to bring out our next panelists, but I do also want to make a mini announcement that thanks to the work of our members and also Justin and Amina and Amanda and a number of folks who participated, we just filed our comments as GBBC for the OFAC FinCEN and the FinCEN anti-money laundering and countering the financing of terrorism programs consultations. While we were putting this event together, we were working on that too. So we finalized it, and it's now in with Treasury. So I appreciate everyone who helped with that. All right, to the next panel. Are you guys ready? We have another all-star group coming together, led by Amina, who will be moderating. And I don't know if you all know this, but Amina got recruited from GBBC. She is now at JP Morgan Chase. So all of what, 2 weeks, I think? 1 week?
Third week.
Okay, third week. And we've got Jorgen, Roshan. All these names are probably very familiar to you, Carson and Chris. All right, I'm going to lead you guys to have the next discussion on next-gen financial infrastructure risks and the opportunities.
Thank you so much, Sandra. And it's such a pleasure to be back with you. Today we're going to talk about next-gen financial infrastructure, risks and opportunities. And maybe to start the conversation, I'll just mention that what we're trying to build today, what industry is doing right now, is to build an ecosystem where the new blockchain rails can coexist with the traditional financial infrastructure and where they can operate reliably, where they can operate securely, and they can scale. And we here have the practitioners from the field who know how success looks like and who can share their insights, their views, and their experience throughout the years that they have gained in this space. So maybe we'll start with quick introductions, and if I can ask you to introduce yourself, the role, the company, and what your company is doing. We'll start with Chris.
Chris Baker. I'm the Chief Administrative Officer and Chief Compliance Officer for 677 Financial Group. We're a principal-based OTC liquidity provider to institutional clients, both do spot, derivatives, and options. Our DNA, our two co-founders with Morgan Stanley running their global currency operations in emerging markets. I was a global managing partner at Accenture. So that's kind of our DNA. That is what we do. I guess that's a short thing. I will say one thing. So the other guys are all trading, and I say, what's your role? And I say, I'm head of EBT. And everyone looks in like it's a really important thing because no one knows what EBT is. And I say, it's everything but trading. So that's my role.
So happy to be here. My name is Jorgen Ouaknine. I'm the global head, unfortunately, of innovation and happily of digital assets at a small fintech called Euroclear. It's FMI based out of Brussels. So, that's the European voice we bring to DC. And basically, we're moving on chain, at least part of our activity. And I think the part of our activities is the important nuance we're trying to bring there. And, I'll let my colleague from DTCC give the big numbers. And basically, you can divide that by 2, and you'll get the sense of what we do.
Good morning, everyone. Thank you for having me. Carson McClean, I'm Deputy General Counsel at DTCC. Overseeing primarily DTC, the depository, but also today a lot of our digital asset work. I'm sure folks are very familiar with DTCC, but as I mentioned, really looking to bridge that gap between traditional, what we've been doing for many, many years, into the digital space to enable our participants to have greater access.
Thank you. I'm Roshan Robert. I'm the CEO of OKX US. OKX is the second largest crypto exchange in the world, and we launched the US market around a year ago. I joined the firm 2 years ago to sort of build out the franchise, build out the team, build out the products, which we did, and we launched the market around a year ago, and we continue to scale both on the institutional side as well as on the retail side. And as an engineer, it's great to be speaking at a law school. So thank you for inviting me.
And Sandra has already introduced me. I'm Amina Turgulova. I've recently started working as a digital assets risk management and compliance lead at JP Morgan Chase. But before that, I had a wonderful journey with GBBC team here. So let's talk about opportunities. Over the few years, we've seen a lot of pilot projects, but what did really scale and what has a promise to become adopted, reliable, and scalable? Jorgen, can we start with you?
Yeah, with pleasure. So I want to give, first of all, a lot of credit to all the pilots, because now we say we move out of pilots, we have to go to production. That's fair, but if we didn't have all these pilots the years before, we wouldn't be able to have the maturity we have today and all the knowledge. So first of all, kudos for everyone who tried and basically shared the knowledge with our great community, because the digital asset world is a community. And if we think about from a financial market infrastructure perspective, and again, so I'll give the numbers. So we have $45 trillion under custody, and we process every month the world GDP on our books. That just gives a sense and about scale and the importance of how we need to get it right. So again, moving from pilots to production. And we think about it from, we need to provide the rails and the infrastructure. And if you look at the journey we have had in the blockchain world, the first phase was really ideological. Everything about blockchain was a new philosophy and a new way of looking at assets and money. The second phase was technological. We need to make it work. And now I think we're in a phase, and I hope that's a real word, where it's infrastructural. We need to have the right infrastructures to be able to progress globally. Otherwise, you won't be able to have the scale and move the assets that we're having. I think, and what our colleagues from DTCC are doing, they're clearly leading the way forward, but I'm sure you're going to talk about it. But again, you can summarize the needs for infrastructure into three main pillars. You need tokenization capabilities, otherwise you won't be able to bring assets on chain. Digital asset custody or wallet infrastructure, because that's the gateway for the clients to the assets on chain. This is where you have the policy engine, the KYC, AML, and everything we love about that. And you need to have networks. And if you combine these three new core capabilities, there's not many use cases you cannot deliver.
Thank you.
Yeah, I mean, I would add to that. It's funny you mentioned the pilots are ahead of our digital assets. We have an event coming up in July, and she was like, "Do not call it a pilot. Do not call it a pilot." And then coming from the legal side, I'm like, "Let's just make sure it's a pilot. It's nothing like to couch any legal liability." But very similar to what Jorgen said, we are really starting to transition from kind of the testing pilots into real production. What can we actually do with this? So at DTCC, where we have 114 trillion, I think, under assets, we want to enable digitization of those assets, not tomorrow, but in the near future, so our participants can use them with this new technology, doing new things with them. And we really see ourselves as central to that, like we are today in traditional markets, being that bridge, enabling the infrastructure, enabling the access, so our participants can go and do the things they want to do with it. We're certainly not picking winners and losers and what they want to do with that. We'll let the market decide that, but we certainly don't want to be the one kind of bottling things up. So we've been working with the regulators. They are obviously key to this whole process. We recently gotten relief from the SEC to enable a tokenization service for a period of time. Obviously, similar to Euroclear, DTCC is highly regulated, and so we wanted to work with the regulators to say, hey, fully appreciating our full regulatory responsibilities, can we have a period of time where we can kind of, in a production environment, test these things, go out, make it enabled for our participants, and then develop over time. Really like we've been talking about as a crawl, walk, run phase. We're in the crawl phase at the moment. And so we were able to get regulatory relief from them from having to comply with all of the high regulatory obligations for this service for a limited period of time. with obviously lots of reporting to the regulators, as they love to see. And so in July, we're going to have an event, not calling it a pilot, it's an event where we are going to have a limited number of participants using real live traditional DTC securities held by those participants, enable them to tokenize it, and do a one-day event where they'll have different test cases, different protocols, different app chains, at the moment at least 2 different blockchains that they'll be able to move the assets on. And then obviously receive as much information we can from that event, and then go live with the service in October is the plan. Again, still kind of crawl, walk, run. Everything will be limited securities, and everything will be controlled through DTC, just to make sure we are still serving as like a good control location for our broker dealers and our banks. But very excited to be really moving, and it's, from my legal side, coming much more quickly than we're probably comfortable with.
Chris.
One, I've never felt so small in my life with 114 trillion, and I look at our balance sheet, I'm like, well, someday.
Yeah.
But you did mention use case, and I thought you brought it up where some of these new things are coming out there. So in addition to our core trading business, we do market making, liquidity provision for digital assets. We also do advisory. So one, which is actually number 2 in the little blue book, which we're in the blue book, is Nat Gold Resources, where they actually take unmined gold, digitize it, and then that'll be out there as a digital asset. And we worked with them for several months. They'll be going out in about a month. But that's where they take the asset of just assets in the ground, not going to mine it. It also has a very good environmental piece because the gold sits in the ground, is not going to get mined. So they look at it as, I've got a baseline gold price, I've got the cost to mine, the underlying asset sits there, so the price would be kind of net of those two, and that's how that asset will be coming out. So that's one of the little things out there, something will come out, get on the rails, and move forward. So,
Fantastic. Roshan,
Yeah.
you've introduced lots of new products across Europe and US, and where's the consumer demand really?
Yeah, no, I'd like to sort of really touch upon consumer demand and also some of the points that my colleagues here on stage brought up. To the point that there will always, as a technologist, I believe there always will be a lag between pilots and production systems, right? And to understand the reason why, I think we need to go back in time, in history a little bit, I think. People ask the question as to sort of, how did crypto grow to an extent where it is taking over public imagination and it is changing the way financial infrastructure works? And to be fair, crypto definitely as an asset class had a role to play, but technological innovation had a greater role to play. So, there's a gentleman by the name of Ray Kurzweil, who's a scientist at Google, who coined the term the law of accelerating returns. And what it essentially means is that, technological innovations always build on top of the previous one. And in that sense, technological innovation is always cumulative, right, or exponential. But the human mind always thinks in a linear fashion, right? So just to sort of take that example, if you look at, back in the time when I started dabbling in Bitcoin, this was 2013, 2014, the smartphone was being adopted around the world, right? And there's a point that the Deputy Undersecretary also brought up, right? And back in 2014, there were around 1 billion people around the world who owned a smartphone. Fast forward that to the end of 2025, there are nearly 4.5 billion people or more who own a smartphone, right? That's 65% of the population of the world. They own a device that gives them access to data and information and analytics 24/7. And these are the people who in time want to use that information, and they want to use that information in markets that work 24/7, right? And and that's what crypto did from the beginning. We developed marketplaces that work 24/7 and where you can settle your products instantaneously. And today, around the world, there are nearly 750 million customers who buy and sell products in these markets. And that's not going away, right? OKX alone, we have 120 million customers in 180 different countries around the world. These are customers who are used to these new technologies and who want to operate in markets that are 24/7. So that is, so those are technological innovations that took this market to where it is today. So today, when we talk about 24/7 markets, when we talk about instantaneous settlements, these are requirements. There's no going back on this. These are requirements if you need to operate in tomorrow's financial infrastructure, or if you need to build tomorrow's financial infrastructure to service customers, because at the end of the day, everything that we built is based on customer demand. And those customers, those 750 million customers and growing, they're demanding this. So there is no choice when we talk about 24/7 markets and when we talk about instant settlements, right? So how did this all begin? Where did we get to? Where are we today? Today, we are in a place where we need to be putting more attention, more regulatory attention, more technological attention, more investments into innovators who are building in these 24/7 markets in public blockchain markets, right? And that is the reason why public blockchain markets are the future of finance, so to say, right? Now the question, Amina, that you asked about where do we go from here, right? Like I mentioned, technological innovation is always exponential, right? And the best companies out there try not to think in a linear fashion, right? And the next stage is an agentic economy that is building out, right? AI and this confluence of AI and public blockchain markets is sort of like the next paradigm or the next or the next horizon that we need to sort of really breach, so to say. And that's what the best infrastructure companies in the world are building today. And if you talk about that next horizon and how we are approaching it, we're building. We recently announced. Actually, last year we announced the build out of what we call as an on-chain operating system, which essentially exposes a tech stack behind our wallet and allows developers to build applications that can cut across 100 public blockchains, right? And then on top of that, we built an agent trade kit, which essentially is an open source MCP toolkit that developers can use to test and deploy strategies, agentic models on public blockchains. And on top of that, we announced the build just earlier this year of an agentic wallet, which essentially is a wallet that can be used by AI agents, right? And those are kind of the foundational infrastructure that you need to have to enter into the agentic economy, right? And you can't, and as Jorgen rightly said, you can't just have technologists sort of really develop all this without having the foundational controls in place. So we have a foundational AI policy, we have a risk management framework, we have the governance around all of these new gen products that we are developing, and that's also equally important. So I hope that kind of answers the question as to how innovation is taking place in this space and why that is important. That is important because at the end of the day, you build what the customers need. Pilots fail because those pilots are not really understanding what the customer needs.
Don't really have economic adoption. Jorgen, would you like to comment on the AI component and how it is used by the financial market infrastructures? Is it really next gen?
There's a direction of travel and there's no coming back from it. So I think that's the common point. And basically, it's the new digital frontier. The smartphone is going to be to the phone what the smart contract is going to be to the contract what the smartphone was to the phone. But I think, to go back on what you said on the client demand, I think it's important to basically make a distinction. There's the retail side of things, and there's the very institutional side of things. And I think the speed there is absolutely not the same, and the demand is not even the same. So we are B2B, never to C, and you seem to be a B2B very often to C type of client. We don't have 120 million clients. I think we have north than 2,500. And I think, the top of the list might be 80% of the business and the biggest institution in this globe, and the demand is not necessarily the same. And this is why it cannot be one size fits all. And it's super important that we recognize that both from a risk perspective, or from a rails perspective, and both from a regulatory perspective in what we're trying to bring, because what's at stake is absolutely not the same. So the 24/7 markets, it's great, but that's not everything we receive as a request today. And they rather go in phases that would make sense to be able to scale, rather than be a maximalist of everything. And this is where I believe that our biggest challenge when it comes to client demands is how do we give them access and service all kind of assets, regardless if it's digital, if it's traditional, or whatever, even if it requires different core capabilities, but in somehow a seamless way. And that's why I'm not a big fan of the distinction between TradFi and DeFi, because at the end of the day, it's all Fi. And that's super important as a distinction.
Thank you. Well, we have less than 20 minutes left, and we haven't talked about risks. And I really want to talk about risk mitigation framework, the industry-led initiative facilitated by GBBC, and both DTCC and Euroclear core participants of this initiative. So how the next gen and innovation in financial market infrastructure actually changes the existing risk frameworks and enterprise risk management processes, and where the risk mitigation framework supports the financial institutions in terms of recalibrating, refining, and maybe adapting the existing frameworks.
So if you allow me to go first on this one, and I'm very surprised that I'm going to say it myself, I couldn't be more excited about the risk mitigation framework. And that's why I said I'm unfortunately head of innovation and happily head of digital assets, because while it is in innovation, you still have the pilot concept. And when it goes, it has to move out. You have to self-disrupt ourselves to put that in a proper business line, being transversal. And in order to do that, if you want to move from pilot to production, you need to have the right risk framework in place. Unfortunately, let's imagine, God forbid, there's a market event. You have a very talented team in our institution that gather together, regardless of the time of day and weekends and whatever. They'll open the process book, page 12, chapter 2, they'll have a solution for that. If I basically call them and say, listen, there's a problem with a poison oracle on the public blockchain and the smart contract failed, sorry, what's the topic about? And so we have to document that. And the challenges for the companies now is not anymore about the technology. It's a given. It's not an if. It's a when. We've been there. There's market demand. Everything is very clear. So now we need to basically go back to what the RMF version 1 was. Basically, what are the new risks that we need to address and we need to understand? what are the existing risks that need to be changed, and what are the things that will always remain in place. Regardless of what we do, OFAC sanctions are not going away. But the risk linked to a public blockchain or something happening there, that's a new risk. And the new architecture, the L1, the L2s, and whatnot, are coming into play in all that. So the thing is, we're quite happy to have budget, but I'm always saying, as a good colleague, if you give me money, please give money to ops, to legal, to risk, to everyone, because we need to move in sync. And I think the word sync is the most important one, because this is how we're going to get to scale as well globally, because one of the biggest challenges we might have actually is how do we get in sync with the regulator, with the technology provider, with the change management and transformation inside the companies and the client demand. If you don't move in sync with all that, you might be miles ahead, but what's the value of being alone if everyone is behind? So getting in sync, I think this is a role we see Euroclear, DTCC, and other play, because we move with an ecosystem. That's the most important part, and that's where we see clearly the risk mitigation framework, and hopefully the work that is going to continue, provide value, awareness, education, and adoption in everything we do, because people come to us for resilience, trust. We sell trust. We sell resilience. People know we're here. And we sell the rails that these assets are going to move on. That's what we do.
Fantastic. Carson, would you like to add?
Yeah, I would agree. The in-sync is necessary. And I think the foundation for in-sync is a common language, right? You could be using the exact same words, but if the vocabulary and understanding of those words is different, you're not going to be in sync, and you're not going to get anywhere. So I think the RMF really helps lay that foundation and puts everybody on the same page, and then you can build from there. And the way you build from there is, at least our perspective, not a prescriptive, you must do X, Y, and Z, but it's a principles-based. Whether it's through existing PFMIs, in the US we have the clearing agency standards for our clearing agencies, but those all have to be based on the same foundation, the same common language, and then you can build up from there. Which then brings it back again, as you're all building up in your own area with a common language, then you can come back to the table and have things like equivalency, right? To be able to build further, you're going to have interoperability between the US, between the EU, UK, throughout the world. If you're going to connect all these different customers, there has to be interoperability, which all comes back to that kind of fundamental language. And might as well start with risk, because if you're not going to address risk, who's going to want to involve themselves in it?
It'll find you.
Maybe to add on that for a second, because we just published a white paper together with ClearSkim as well, defining interoperability. Yeah. Not only moving a token from layer 1 to whatever layer, but between traditional system, DLT system, between jurisdiction, operation, etc. So you should check it out. It's on.
Would you like to highlight some major risks that you guys revealed in this interoperability report?
I think it was more about aligning the language, because when you say it has to be interoperable, okay, so what do you want to do actually? What does it mean? And I think it puts things in perspective. And I know GBBC has as well done a lot of work on the taxonomy, and that helps a lot getting everyone aligned on what we actually mean by that.
Chris, how's your company adopting the new risk mitigation framework, and how it lays into the existing enterprise risk management framework?
I think we've been doing it, and we just found a home for it, essentially the way I would call it. So I would say, going back to our DNA, right? We're not at the size and scale of our other colleagues here, but when you come from Morgan Stanley, you come from Accenture, you have a way of doing things. And so when you go back to trust, when we started the company, when we were talking about the experience we have here, we actually went out and trademarked the firm trusted in global markets. So that's what we're about. So when we go through all of this stuff, I look after information security and compliance and all sorts of things. So when I look at what our information security team is doing, our threat models, how we look at risk, how we manage that risk, how we look at compliance on financial crime risk, how do we manage all of that stuff? How do we look at our digital assets when we review a token, right? When we're really going into it. And a good example is Zcash. We looked at that. All the technical audits are clear. Last Friday, they come out, thanks to AI, I think it was Anthropic, found the issue, published it, went from 600 to 300, in a flash. It's back to like 400 some odd now. But those are huge stresses on the system, even despite the work we do, because we do like a 30-point framework looking at some of these assets. And again, that's how we look at managing risk. So frankly, when I looked at the RMF, I was like, oh, all the stuff we're doing has a nice home that sits in the novel framework of what kind of the digital asset space has, right? Because we come from other industries where we look at risk holistically enterprise. So we have a lot of experience right on enterprise risk from a financial perspective, given the Morgan Stanley DNA, but all of that together has a very nice home with the RMF. So I'm frankly excited to, from a practical perspective, use it, explore it, advance it, change it, so that it works for practitioners like us, if that gives a quick summary.
Thank you. Yeah, this is fantastic to learn that it's practically implemented across the globe. Roshan, you adopt so many new products, all kinds of services you provide, including custody, payments, on-chain earnings, staking, wallets. What are the risk mitigation principles you will not compromise on?
Great question. So when we started this build, the one thing was certain: we are technology. We are a technology-first firm. We have 2,500 engineers who, maintain and build systems for our customers. Having said that, what we've done is we've taken all of that technological expertise that we've built over the years and placed it on what I call as sort of the 5 pillars of finance, so to say. So compliance. There is a rigorous compliance program that cuts across all aspects of compliance risks. We have nearly 300 people in the compliance program managing that around the world. And we've hired some phenomenal talent over the last couple of years within our compliance program. Risk. So we built out an internal risk management program that cuts across every aspect of risk, be it liquidity, market risk, be it operational risk. That team is now around 70 strong with some very experienced people, and our risk management framework is incorporated into everything that we do, right? The center pillar is cybersecurity. We're talking about moving money on the internet. We're talking about cryptographic keys. So cybersecurity is so very important. So we have a robust cybersecurity program. Interestingly, I am a CEO who rigorously takes part in the tabletop exercises, because that tells me exactly how we're doing. There's a military saying that says, the more you sweat in peace, the less you bleed in war. So, those tabletop exercises, those failover drills become so important, because when a real situation hits, you want to know exactly how your command center is going to perform, right? And that is important. And then, of course, another pillar is our customer best practices, right? So making sure that we have a supervisory system around sales practices, and making sure that we are very rigorous around how the customer is charged, the disclosures that we need to provide to our customers, making sure that our products are fit for purpose. So there's a rigor around that. And last but not the least are the controls we have around client money, which goes back to how I started my career in financial services. As I stepped into financial services, that was the year that the financial crisis happened. So I have that, PTSD driving my focus on client money controls as well. So I hope that answers the question that you asked about.
Hopefully you will recover from it. Jorgen, Carson, would you like to comment about the stress situation? What happens when things go wrong, and what type of preemptive maybe efforts you've done in order to avoid any disaster situations?
So, unfortunately, this is not an if question. We know things are going to go wrong. That's part of life. And if you look back at the 60 years we have been founded, you will clearly see that we have whatever it takes to be able to cope with any major market events, innovation, crisis, you name it, and that's quite interesting. Now, if you try to apply that to a use case, like for example, tokenized collateral, every other companies telling that this is the huge unlock for digital assets, and I think it has a lot of value. People are keeping buffers everywhere just in case, and that costs a lot of money for the clients. And with the programmability of assets, they can be at the right place just on time. So for moving from just in case to just on time. The question with collateral is that it has value when there's a crisis. And then the question is, who's going to accept your tokenized collateral? How fast will it be? And if you look at what might have happened in the past during COVID or other periods when people were buying and selling US treasuries, for example, you always found sellers most of the time, but you had like a stress on the price. So it's not even the same. And if you look as well in Europe, we issued a tokenized bond of World Bank, AAA rated on Euroclear. As I often said, couldn't get better than that, and was still not the central bank, European Central Bank collateral eligible, which is the case today. So again, it's going in sync. But this is a moment where we need to be able to test the stress. Let's take a collateral use case in a moment of stress that we might have experienced in the past and see who's going to buy it, are they able to hold it, how do you unwind the position, and how do you actually provide the value when it's the most important for our clients.
Thank you. Carson?
Yeah, I agree. One with the collateral, I think collateral is a huge unlock. DTC is working on a collateral app chain to enable its participants either with DTC minted tokens or other collateral where they can then more efficiently, effectively prioritize, move, deploy that collateral in situations so you can reduce that exposure of being over-collateralized at any point in time. And then more easily, when risks come up and issues happen, which they will, you can more effectively and efficiently move that stuff 24/7, and hopefully at one point across however many jurisdictions. But how do you do all that? So, like Euroclear, we are so highly regulated. The regulators want to know, what are you going to do? The number of times they come up with hypotheticals, you're like, all right, I guess we have to figure out an answer to this one. Is both looking at the traditional risk management aspects and then seeing, from that principles-based, where is the new risk? Where is the new exposure in this digital environment? Do we still have the same construct that we can apply, or do we have to come up with a new construct? And one of the things I think is a huge unlock in the digital space is the smart contract, right? So if we're going to tokenize something, we create the token, we put our smart contract in it, and we can tell the smart contract, don't let this do ABC. And it won't do that, right? So right now, again, in that kind of crawl phase of the crawl, walk, run, only our participants are able to access our services, same as today. They're the ones that will be able to hold a token of their own assets. And the smart contract that we're going to produce with our tokens will only allow it to be held between DTC participants. Now, they can go and do other stuff with it, but it still is associated with their wallets, right? And if they have an issue, again, something's going to happen at some point in time. There's multiple layers of risk mitigation, both in the smart contract controlling what it can do, but then also DTC as the administrator, we can just burn and remit. So if a chain has some type of failure, nodes have some type of failure, we're able to verify that through the chain, through our participants. They either have or open up another wallet somewhere else. We'll just burn and remit for them. Or if there's concerns about the asset going to a wallet that is not associated with us, again, it's already built in that smart contract that it has to be with a wallet registered with us. So that was kind of one of the roles that we play, is enabling that trust, that accountability both for our participants and for the regulators.
Thank you so much. We're almost at time. Time flew. But maybe if I can ask you, spend maybe 30 seconds on your answer and tell me what is one inevitable opportunity that lies within the next 12 months, and what is the major risks the markets are underestimating? We'll start with Jorgen.
I think the major risk we're underestimating is the one we don't know yet, because we're still learning every day. And I think, one of the big unlocks is definitely the wallet infrastructure with the right regulatory wrapper to make it a qualified custodian.
Thank you. Chris?
I was thinking risk and volatility, but as you go through this, to me, I think it's some of these AI threats that are, I think from an information security perspective, you can see what it does, how it diagnoses issues. So it works well on defense, but also works very well on offense. So I'm a little bit concerned about the offensive capabilities that can be deployed against our infrastructures. I think that's out there.
Thank you. Carson?
Yeah, I would have to agree with Jorgen. It's a thing you're not thinking about, right? We're thinking of quantum computing, we're thinking of AI. You're like, oh, it's going to be the thing. As lawyers know, it's the thing you didn't really think about. So you hope you have a belts and suspenders for those situations. But for the unlock, I think it's going to be, at least from our vantage point, that bridging of traditional and the DeFi world with the non-pilots for the testing, and then the actual launches that we're going to do this year, to give our participants a view into like, oh, this is actually has production value. We can do stuff. And I think that's going to really kind of blossom the ideas and the forward movement.
Thank you. Roshan?
Yes, so well, there's always a tango between opportunities and risks, as I would say. And I think the greatest opportunity in front of us is the development of the right type of AI products that would spur consumer demand. And when you build that, you need to make sure that you're not just building the product, but you're building the trail of controls that help you manage that product in the right way. The right kind of policies, the right kind of governance, the right kind of risk mitigation frameworks around those products are equally important, which is why you need to have a certain amount of discipline, a certain amount of regimentation, a certain amount of focus around these kind of builds. And I think only the infrastructure firms that are deep set in public blockchain technology will be able to sort of really produce these products.
Thank you so much. It's been a truly insightful and pleasant discussion. Thank you for sharing your knowledge and expertise. And we hope that innovation is going to scale and scale responsibly. Thank you.
Thank you very much. Thanks, everyone.